Imagine stuffing your hard-earned cash under your mattress, believing it's the safest way to keep it. Now, what if I told you, doing just that, or even the modern equivalent, like putting it in a savings account, is silently eating away your future wealth? Shocking, right? Here's why finance experts are turning the tables on what we've been told about saving money. In today's world, inflation is like a silent thief, sneaking into your savings and reducing their value day by day. Did you know that if inflation rates are at a modest 2%, the purchasing power of your money halves in just 36 years? That means what $1,000 buys today will only buy $500 worth of goods in a few decades. And here's the kicker. For many of us, the actual inflation rate is even higher, making the erosion of our savings even more rapid. But wait, there's more. While your savings account offers a safety net, it's paying you interest at rates that are often laughably low, sometimes not even enough to keep up with inflation. It's like running on a treadmill that's speeding up, and you're just trying to keep pace, not getting anywhere fast. So, what's the solution? Enter the world of investing, a realm where, with the right knowledge and strategies, your money doesn't just sit there. It grows, outpaces inflation, and secures your financial future. From understanding the power of the stock market to leveraging real estate, and even decoding the psychology of money, we're on a journey to unveil the secrets that finance experts swear by, pushing you to rethink saving and start investing. Stay tuned as we debunk myths, uncover facts, and equip you with everything you need to shift your mindset from saving to investing, ensuring that your financial future is not just secure, but flourishing. Chapter 1. The Savings Paradox. Have you ever thought you were doing everything right by stacking your hard-earned cash in a savings account? Well, hold on to your hats, because what we're about to uncover might just turn your financial strategy on its head. It starts with a simple truth: not all savings are created equal. While tucking away money for a rainy day sounds like solid advice, it's only part of the picture. You see, the real game changer is not how much you save, but where you put those savings. Let's break it down. Imagine you've been diligently saving $100 every month. Feels good, right? But here's the kicker. If that money is sitting in a traditional savings account, it's probably growing at a snail's pace. Now, don't get me wrong, saving is crucial, but it's the equivalent of keeping your money under a mattress if you're not considering its real value over time. This brings us to a concept we'll call the savings paradox. It's the ironic situation where people save money, thinking they're being financially responsible, but in reality, they're losing purchasing power over time. Shocking, isn't it? Chapter 2. Understanding inflation. Now, let's tackle a silent savings killer lurking in the shadows: inflation. Inflation is like that quiet roommate who eats all your food without you noticing. It's constantly nibbling away at the value of your money, and here's why that's a big deal. Picture this. 10 years ago, with $100, you could fill up your car's tank, grab a nice dinner, and still have change left over. Try doing that today, and you'll quickly realize that $100 doesn't stretch as far. That, my friends, is inflation at work. Inflation averages about 2–3% per year. It seems small, but over time, it adds up, significantly reducing your money's purchasing power. So, if your savings aren't growing at least at the same rate as inflation, you're effectively losing money. Here's an eye-opener. If you had $10,000 in a savings account earning 1% interest annually, but inflation was chugging along at 3%, after a year, your savings would be worth less in terms of what that money could buy. It's like running on a treadmill and realizing you're actually moving backward. This is why finance experts are nudging us to reconsider our saving strategies. It's not just about saving, it's about smart saving and ensuring our money works as hard for us as we do for it. So, what's the solution? Stay tuned as we explore alternatives to saving that can help you beat inflation and secure your financial future. Chapter 3. The Investment Alternative. Investing. It's a word that might bring to mind the chaotic floors of stock exchanges, but it's also a key to unlocking the potential of your finances beyond the slow growth of savings accounts. Here's the scoop. While saving money is like planting a seed in your backyard, hoping it'll grow with time, investing is more like planting a whole orchard. Sure, there's more work, maybe a bit more risk, but the fruits of your labor? Significantly more abundant. Why invest? Think about it. Inflation's constantly nibbling away at the value of your money. What you could buy for $1 yesterday might cost you $2 tomorrow. But when you invest, your money's not just sitting there, it's out there, battling inflation, sometimes even outpacing it. It's like giving your money a job and then seeing it bring home more than just its original salary. Starting simple. You don't need to jump straight into the deep end with stocks or real estate. Mutual funds, for example, are a great starting point. They pool your money with that of other investors, spreading it across a range of assets. It's like dipping your toes in the investment pool without worrying about diving too deep too fast. Compounding your best friend. Ever heard of compounding? It's when your investments earn returns, and then those returns earn more returns. It's the financial equivalent of a snowball rolling down a hill, growing bigger as it goes. Starting early means you give your investment snowball more time to roll, grow, and, ultimately, build wealth. Chapter 4. Risk versus reward. The balancing act. Investing isn't without its risks, but here's the kicker: not investing is a risk too. Keeping all your money in savings means you're almost guaranteed to lose value over time due to inflation. The trick is finding the right balance between risk and reward for you. Understanding risk. Different investments come with different levels of risk. Stocks, for instance, can offer high rewards but with high volatility. Bonds, on the other hand, are generally more stable but offer lower returns. Knowing your risk tolerance is key to building a portfolio that feels right for you. Diversification. Don't put all your eggs in one basket. One of the golden rules of investing is diversification. It's about spreading your investments across different assets to reduce risk. Think of it as betting on multiple horses in a race. Even if one doesn't perform well, the others might, balancing out your overall risk. The time factor. Your investment strategy should also consider your time horizon. If you're young, you might afford to take more risks, aiming for higher returns over a longer period. As you get closer to retirement, you might shift towards more stable, lower risk investments. Informed decisions. Lastly, staying informed is crucial. The world of investing is dynamic, and what worked yesterday might not work tomorrow. Keeping abreast of financial news, understanding market trends, and even consulting with a financial advisor can help you make decisions that align with your financial goals and risk tolerance. By shifting our focus from merely saving to strategically investing, we not only protect our finances from the erosive effects of inflation but also set the stage for potential wealth creation. In the next chapters, we'll delve into the psychological barriers that often hinder our financial decision-making and how to overcome them. Stay tuned. Chapter 5. Psychology of money. Money isn't just about numbers, it's about emotions, beliefs, and behaviors. Understanding the psychology behind our financial decisions can be the difference between growing wealth and staying stuck in a financial rut. Let's explore how our minds play a crucial role in our financial health. Emotional spending. Ever found yourself buying something you didn't need, just because you were feeling down? That's emotional spending. It's a temporary fix, like a band-aid on a wound that requires stitches. Recognizing and addressing the root causes of emotional spending can help us make healthier financial decisions. The fear of loss. Humans are wired to fear loss more than they desire gain. This fear can paralyze potential investors, keeping them in the safety of savings accounts, despite the allure of higher returns through investing. Overcoming this fear involves education and gradually stepping out of one's comfort zone. Analysis paralysis. With endless financial products and conflicting advice, it's easy to get overwhelmed. This often leads to analysis paralysis, where the fear of making the wrong decision leads to no decision at all. The key? Start small, learn as you go, and remember that no action is often the costliest choice. The power of habits. Our financial health is largely determined by our habits. Small, consistent actions, like regular investing, even in small amounts, can lead to significant wealth accumulation over time. Building positive financial habits requires discipline and a focus on long-term goals over immediate gratification. Overcoming biases. We all have biases, like the tendency to overestimate our investing prowess or to follow the crowd without due diligence. Being aware of these biases and actively working to mitigate their impact can lead to more rational and profitable financial decisions. Chapter 6. Building a financial safety net. A financial safety net is crucial for weathering life's unexpected storms. It's more than just a savings account, it's a comprehensive strategy that ensures financial security and peace of mind. Emergency fund. The cornerstone of any financial safety net is an emergency fund. It's recommended to have at least 6 months' worth of living expenses set aside in an easily accessible account. This fund is your buffer against unexpected events, like job loss or medical emergencies. Insurance. Often overlooked, the right insurance policies, health, life, disability, etc., are integral to your financial safety net. They protect you and your loved ones from the potentially devastating financial impacts of unforeseen events. Diversified investments. While savings and insurance are defensive components of your financial safety net, diversified investments represent the offensive. By investing in a mix of assets, you not only aim for growth but also protect yourself against the volatility of any single investment. A debt management plan. High-interest debt can quickly erode your financial safety net. A solid plan to manage and pay down debt, especially credit card debt, is essential. This might include strategies like debt consolidation or prioritizing debts with the highest interest rates for repayment. Continual education. Lastly, staying informed and educated about personal finance and investment strategies is an ongoing process that strengthens your financial safety net. Whether through books, podcasts, or courses, continual learning empowers you to make informed decisions and adapt to changing financial landscapes. Building a robust financial safety net is a proactive process. It involves more than just stashing money away. It's about creating a comprehensive plan that covers emergencies, protects against unforeseen events, and includes a strategy for growth and debt management. As we move forward, we'll explore how real estate and the stock market can play pivotal roles in transforming your financial future. Stay tuned for an insightful journey into making your money work harder for you. Chapter 7. Real estate as a financial tool. Real estate, often touted as one of the most reliable paths to wealth. But what makes it so special? Let's break down how investing in real estate can elevate your financial game, offering both stability and growth. Tangible asset. Unlike stocks or bonds, real estate is a tangible asset. You can see it, touch it, and use it. This tangibility offers a sense of security that intangible assets can't. Plus, real estate has a lower correlation with other asset classes, providing diversification to your investment portfolio. Passive income. Rental properties can generate ongoing passive income, creating a financial cushion that grows over time. Imagine having several properties, each contributing to your monthly income. It's like having multiple streams feeding into a river of wealth. Appreciation potential. Over time, real estate typically appreciates in value. This means that the property you buy today could be worth significantly more in the future, offering a lucrative opportunity for long-term investment. Leverage. Real estate allows for leverage, using borrowed capital for investment purposes. For example, you can purchase a property with a 20% down payment and finance the rest. If the property appreciates, your return is calculated on the total property value, not just the amount you initially invested. Tax advantages. Real estate investors benefit from various tax deductions, including mortgage interest, property taxes, and depreciation. These incentives can significantly reduce your tax liability, making real estate an even more attractive investment. Chapter 8. Stock market basics for beginners. The stock market can seem like a daunting place, but it's also a playground for growth. Let's demystify it and discover how it can be a powerful tool for building wealth. What are stocks? Stocks represent ownership in a company. When you buy a stock, you're essentially buying a piece of that company. As the company grows and becomes more valuable, so does your investment. The power of compounding. One of the stock market's greatest advantages is the potential for compounding returns. Reinvesting dividends to buy more stocks can accelerate your investment growth, turning modest initial contributions into substantial sums over time. Diversification. Investing in a range of stocks across different sectors and geographies can reduce risk. Diversification ensures that a decline in one area won't necessarily devastate your entire portfolio. Starting small. Thanks to technology, you can start investing in the stock market with very little money. Apps and platforms now offer fractional shares, allowing you to buy portions of a stock. This means you can get started with investing, even if you don't have the funds to buy whole shares of expensive stocks. Educate yourself. The most successful investors are often the most informed. Take advantage of resources like books, courses, and financial news to understand market trends and investment strategies. Remember, every investor starts somewhere, and knowledge is the key to confidence and success. Investing in real estate and the stock market are two strategies that go beyond traditional saving, offering paths to wealth that can outpace inflation and provide financial security. As we move into the final chapters, we'll explore retirement planning and actionable steps to make the shift from saving to investing, ensuring you're equipped to navigate your financial future confidently.